Welcome to Prescribing Prosperity with your hosts, John and Alex Soutsos from MedWealth Financial Services, operating through IPC Securities Corporation. In this podcast, we provide unique insights into wealth management, the psychology of financial decisions, and help listeners place the capital markets into perspective. Our aim is to help physicians, business owners, and other medical professionals to live their dream. Life is to live and enjoy, so we'll also cover health and lifestyle-related topics such as food, dining, travel, and unique experiences. Learn how global trends shape our investment strategy as we help you assemble your roadmap to prosperity.
And welcome to the Prescribing Prosperity Podcast with your hosts, John and Alex Soutsos. Gentlemen, good to see you. Guys, we're coming into October, guys.
Yeah, wonderful.
It's like it's Halloween. It's cool, but it's also spooky. It's very spooky when you start talking about it in financial terms, because historically, this is a month that has produced some really scary surprises. The most famous of which, or the most infamous, I should say, of which is the 1929 market crash. In more recent terms and times, there's been the 1987 market crash, which I have some personal connection to. So maybe it's a good time to discuss past market crises in order to gain a better perspective of what we're experiencing today, and maybe get some insights into dealing with them and handling them in our investment approach. Alex, let's start with you.
Yeah, absolutely, Bill. Thank you for the introduction, and I think that's a very good perspective. You know, October has historically been known for the month of the crash, even though September historically has actually been worse in terms of market performance. So since the beginning of the 1900s, we had the Panic of 1907, which was a response to Theodore Roosevelt, who was the president at the time, threatening to rein in some of the large monopolies of the day. And then obviously, as you mentioned, we had Black Thursday, which was on October 24th, 1929. One of the most infamous as well was, as you mentioned, and one that you have personal experience with, which was Black Monday on October 19th, 1987. That's one that both of you were in the thick of your careers. And so we're going to get into a little bit of some stories about what happened and what precipitated that market crash. And then finally, the last major October crash we had was on October 11th, 2007. And that one wasn't so much a single day crash as it was it more marked the beginning of the bear market that became better known as the Great Recession. And from that day on October 11th, 2007 until March 6th, 2009, the market dropped 54% during that time. So obviously it was a tremendously volatile period in the markets, and so there was a great deal of panic and stress that was felt by many investors and many people. There were also two mini market crashes that occurred in October. We had one in October of 1989 when the leveraged buyout of United Airlines fell apart. And then there was another one in October 27th of 1997. At the time, was caused by the ongoing economic crisis in Asia. So we're going to get to all of those. I'm hoping that today will be the beginning of a multi-part series. We're going to see how far we get today and determine if it's going to be a 2 or 3 episode journey. But my plan was to speak with my dad about it. He obviously has a lot of perspective. He's worked through most of these crises, and so he has personal experience with what happened and how he managed them, and also how his clients responded to them, which I think is going to provide some excellent perspective. While no two market events are identical, what's important to note is that a lot of times the media tends to blow up what is going on, and they're trying to drive clicks. They're trying to attract listeners and viewers, and as a result of that, a lot of the headlines that come out of the media tend to be a tad hyperbolic. And so it's important to is that understating it, Bill?
I think that's probably, let's just call it accurate right now.
Okay. Well, the point is essentially that there tends to be a lot of panic that is induced by the headlines that come out, and we want people to understand that although nothing is the same, no two events are ever going to be identical. There are a lot of similarities that happen, and we have learned a lot from past events. And so, as I mentioned, I'm going to take us on a journey here where we can discuss some of these different market events. And then before we begin, Dad, did you have anything that you wanted to add or chime in on?
The only thing I wanted to add to that was the fact that it's October doesn't cause market crashes. It just happens to be the third quarter of corporate earnings reports. And what tends to happen at the start of the year, you have corporations who are making earnings projections into the year, and every quarter they update those earnings projections and guidance. And in a bad year, every quarter tends to get lower and lower earnings projections. And in the third quarter, when the companies enter the earnings confessional, they've run out of time for the year, and so they can't whitewash it any further, and so they lay it on the line in Q3 earnings reports, which are about to begin with the JP Morgan announcement on the 15th of this month. And so that is typically why October tends to be the bottoming, and that's another important factor, is October is the bottoming process of any decline in the market. It's not usually when the decline is initiated. Even back in 87, I know we'll get into that in a little bit, but in 87, the market peaked in the middle of August of 87, didn't peak in October. So October is when things get washed out, and then we restart from there. So just a little bit of perspective on why October is so notorious.
Absolutely. I think that's a great point to make, that a lot of times it tends to be it's not October that's the bad month. It's the events that precipitate it that ultimately lead to what has happened in October historically. So we're actually not going to talk about an October crisis to start. We're actually just going to talk about something that is a market crisis that we experienced in the 1970s that has a lot of relevance to what's going on today, and that is the period of stagflation that we had throughout the 1970s. Right now, obviously, there's a lot of concern with regards to what the federal or the Fed, which is the central bank in the United States, is going to do to continue to combat the ongoing issue with inflation in the economy. And so,
Alex, can I interrupt you here? Let me just jump in for 1 second. Before you get too far down the road, for listeners who may not be familiar with the term stagflation, do you want to give them a really quick explanation of what a period of stagflation is?
Absolutely. Thank you for that, Bill. That's a great perspective to add. You know, when we say stagflation, it's a combination of two different things. It is a stagnant economy, so that is an economy that is either not growing, or worse, it is contracting, combined with a period of high inflation. So what we have right now in our economy is an economy that is still growing. It is growing at a diminishing rate, but it is still growing. But we also have a period of high inflation. And what happened in the 1970s was there was contraction in the economy combined with a rapid inflation. And so that was a very difficult economic period. Mm-hmm. And it was very difficult to pull the economy out of that almost death spiral, if you will. And so when a lot of people look at what's happening today, there's a lot of questions as to whether or not we're going to return to that period and that type of economic uncertainty that we had in the 1970s. And so, although my dad was not working at the time, he obviously lived through it, as did you, Bill, and both of you have some experience on that. So, Dad, I'm going to start by asking you, can you tell us a little bit about what precipitated the occurrence of the stagflation in the U.S. economy in the 1970s?
Yes, so the 1970s inflation, I think, had two principal causes. You had the Nixon taking the U.S. off the gold standard in 1973, and you also had the Yom Kippur War, which precipitated the Arab oil embargo, causing energy prices to skyrocket. And obviously, when you allow the US dollar to float freely without the anchor of gold holding it down, it gives flexibility to the government to spend more money. And essentially, those were the two primary contributors to the inflation of the 1970s. You also had a central banker at the time, Arthur Burns, who, in hindsight, did not have autonomy, or I should say independence, in his position as head of the Federal Reserve. He was influenced by Richard Nixon at the time, and he was acting more as though he was part of his cabinet than he was an independent overseer of the money supply. And so he was not necessarily doing what would have been appropriate at the time, and he did allow the money supply to increase in the initial stages of the 1970s, and that was those were all major contributors to the way the decade played out. If you want an anecdote about what I recall of the time, I was a young boy at the time, but I do recall going to the corner store to get a loaf of bread for my mom, and that was 25 cents. And today, what does a loaf of bread cost? $4.50. So if we talk,
I'm only laughing because it's true.
Yeah, it's actually sad. I mean, we hear the narrative today that certain central bankers historically got control and wrestled inflation back down and defeated it. But inflation has not been defeated. When you have a loaf of bread going from 25 cents to $4.50, that means inflation has been ongoing and continuous. Every inflation increase, whether it's 1% or 10%, is cumulative and is permanent.
Right.
And so while the rate of change on an annual basis may have slowed after 1981, and it slowed from 1981 up until recently, even a 2% incremental increase, an incremental increase of 2%, piles on top in a compounding manner on previous price increases. So inflation has never been defeated. It's been with us continuously, and it will likely continue to be with us into the future. But it's the rate of change that I think everyone is focused on, and the 70s certainly were very troubling during that time.
Yeah, and so just to add on to that, I think one thing to keep in mind is that the standard inflation is an intentional choice. So the actions of Paul Volcker were such that it brought it down to the intentional rate of 2%, but that 2% is still a by design function of the economy. So that, sorry, go ahead.
I was just going to say, Paul Volcker did not have a 2% target. He wanted to get inflation down under control. The Fed eventually did create a target of 2%, but it wasn't Paul Volcker who initiated.
Was it Greenspan?
I don't recall off the top of my head if it was Greenspan, but there was it would have been around the early 1990s. So if those are around early,
that would have been Greenspan.
That would have been Greenspan. Yeah. So that's when they decided that there was going to be an inflation target of about 2%. Canada did the same thing.
Right. Okay. So building upon that, how likely are we to see a repeat of what happened in the 1970s? And before you answer that, I'm just going to throw out a couple of statistics here that I pulled out when I was doing my prep for this. GDP fell from 7.2% in 1972. GDP growth, I should say, fell from 7.2% in 1972 to minus 2.1% in 1974. And during that time, inflation jumped from 3.4% to 12.3% by 1974. And in some places like the United Kingdom, it actually rose as high as 25%. And in real terms, the U.S. economy didn't fully recover until August of 1993 in terms of pricing. So and then the other thing to mention was the oil embargo resulted in a 300% increase in the price of oil, and that was on a global basis. In the United States, it was actually higher. So anyway, so going back to my original question was, how likely are we to see a repeat of something like this right now, given where the economy is at and given where inflation is at in the United States?
It's an excellent question. It's a very difficult question to answer because the events are still unfolding. At the present time, the inflation was caused by an intentional shutdown of the global economy in response to the COVID pandemic, and then an offsetting expansion in the money supply, in addition to a major expansion in fiscal policy expenditures. So that combination of money flooding into the financial system from above in a manner that resulted in far more money in circulation than had been in circulation prior to the COVID pandemic is what has spurred on the current inflation. Now, it is believed by the Central Bank of the United States that the way to deal with the inflation is by raising interest rates and tightening the money supply. And that is one tool that's available in doing so. But unfortunately, contrasting that at the present time is fiscal policy in North America, which is actually expansionary. The governments are spending still way too much money, and they're actually fighting their own central banks, not perhaps intentionally, but for political reasons. They continue to spend more money than is necessary in the economy. And so when you have these two opposing forces going at it, it explains why inflation is taking so long to come down. There is arguably more money available in savings in North America because of the fiscal expenditures by governments than was previously believed, and this is delaying the reduction in inflation. Inflation gets very dangerous once labor costs start going up, because labor represents 3/4 of the costs of most corporations. And compounding what happened in the 1970s, you had the auto workers union, which started getting together and demanding higher rates. And once you get inflation embedded in wage demands, then it becomes very problematic. So everyone is watching what's going on in the labor supply and labor requests for increases. And here we go again. In the last month or two, we've had renewed strikes in the big three labor unions for our automobile workers. So is this inflation going to be tamed? Are we going to get a repeat of the 1970s? It's hard to say. Obviously, one of the major inputs being the removal of the gold standard is not in play. So that's something we don't have to worry about. A better understanding and greater independence of the central bank relative to the political administration is better today than it was in the 1970s. But you really need cooperation on the fiscal side. The unfortunate catalyst of the war that's erupted in Israel and the attacks on Israel on the weekend, on the anniversary of the Yom Kippur War, are not helping the situation. So it does create additional turmoil and instability, and
as well as the ongoing Ukraine-Russian conflict, which is also siphoning money out of the.
Yeah. So you have all these, wars are inflationary by their very nature, and countries don't have monetary resources for wars, and so they always end up borrowing. And whenever you borrow large amounts of money, inevitably you have to pay it back. And there's two ways you can repay it. You can actually reallocate your resources to repaying the debt, which means you're cutting from other expenditures, or you allow your currency to devalue, and that's inflating away the expenditure. And that's essentially what all governments choose to do, because it's politically the most expedient. And we're seeing that all around the world. The U.S. dollar, being the world's reserve currency, is maintaining some stability with the rising interest rates. It was the first out of the gate to raise interest rates during the post-COVID period, and Europe was a little lagging in their response. So the U.S. dollar right now is maintaining its value on an international FX basis. However, the reality is the cost of goods and services have gone up dramatically in a permanent fashion, and they're not going to go back down. And so the inflation lingers. Now, the economic statistics we're monitoring are showing us that there is some pain in the economy. There are pockets where there's contraction occurring. We don't yet have a recession, but there is evidence that things are slowing down. And so we're heading into the final year of the presidential cycle. And as we all know, politically, it is not expedient to have a recession in the final year of the presidential cycle. So I think the central bank is probably going to reach a point where they're going to be in a bit of a panic if they see the economy slowing too quickly, in which case they'll start cutting rates. And if inflation has not yet dropped to the desired level, then it might cause it to cycle back up a little bit. So it remains to be seen what's going to happen in the balance of this decade. In absolute terms, I don't think we're going to see the interest rates that we saw in the 70s. Certainly, we're going to see interest rates that are quote unquote more normal, and some people with a historical perspective today will tell you exactly that our current interest rates are actually more normal than they are high. Especially when compared to the 1970s. So we might see a cycling of interest rates perhaps from 3% to 8% rather than a decline back to the levels we had prior to COVID and remaining there. But there are so many variables, and it's really hard to predict.
Okay, that's a good answer. And I think one of the long-term takeaways from the events of the 1970s was the creation of a truly fiat currency, which has resulted in greater currency volatility over the last however many years you want to call it, 50 plus years. So the next major event that happened, obviously, was something that both of you experienced, which was the 1987 market crash. Bill, actually, before we began recording here, you told me a story that I'd love for you to be able to relay. Before we get to that, though, I want people to understand that Bill is a Peabody-winning journalist with his work on covering the 1987 market crash with CNN at the time, and so Bill actually had a rather unique experience. Why don't you tell us a little bit about what happened, Bill?
Yeah, well, it's the kind of scare you don't forget, and it was an interesting time period. I was producing the Money Line with Lou Dobbs on CNN at the time when the market crash happened. The thing that has always struck me, and I always remember every October, is that on the Friday before Black Monday, we had a stock market analyst on. She was a technical analyst. Her name was Elaine Garzarelli. She came on and she made a prediction based on her numbers that she was seeing on a technical analysis basis. And in short, she basically said, these are really scary numbers. I don't know what's going to happen, but I got a feeling something really bad is about to happen in the stock markets. She was right. She left the show Friday night. Monday morning, the markets opened and the bottom fell out of the markets. And I mean, they fell out. John, you probably remember it well. It was a very, very scary day in the markets. So that story has always remained with me. And the terrible thing in my mind is that Elaine Garzarelli, who should be lauded for her technical analysis and prescience, instead suffered a lot of death threats. And people were causing her and blaming her for the crash of the market, which was just patently, absolutely absurd. But, it went on to really cause her a lot of trouble with her life instead of making her a hero, if you will, in terms of being able to look at the numbers and say, hey, some bad stuff is about to happen. People should pay attention. So,
yeah.
Well, it's interesting you bring up Elaine's name because I know Elaine, not at a personal level, on a professional level. She actually ran some money for a mutual fund company here in Canada called O'Donnell back in the 1990s. And she's quite an impressive economist. And she obviously recovered from the 87 crisis and went on to a pretty good career. 1987 was an extremely peculiar year. I began my career in October of 1986. And what I remember about 1987 was the market just started to go up early in the year and just continued. By August of 1987, and I'm going from memory here, the TSX was up over 40%. I venture to guess the S&P 500 was up a similar amount. I don't have the numbers in front of me. While driving around in the car, going from appointment to appointment, I had the business news on, and they had an analyst from one of the major brokerage firms in Toronto talking about how great the market was, and can it continue? And the analyst was saying, well, you know what, it is these results are the market's doing really, really well, and we just don't see any reason why it's going to stop. We believe things will continue to improve. And I find that unusual in today's world that they would be such cheerleaders for the market, especially with the knowledge that there was a at the time interest rates had already started to rise during the period.
Yeah.
And when you get a contraction in the money supply, inevitably it's going to squeeze the asset values of both real estate and stocks. So by the middle of 1987, we were at these very high valuations, and then a turn was made, and there was a steady decline from the middle of August of 87 until what unfolded in October of 1987. I also remember October 16th, which was the Friday. The market actually had dropped 5% on that Friday.
Right.
And I had a client at the time who had given me some money to invest. I thought, this is great. I'm going to be buying in at a bit of a discount.
Ouch.
Wow. In hindsight, that was that was an unpleasant feeling. And then on the Monday, all hell broke loose, and we were far less sophisticated at the time. I was with a firm that dealt only with mutual funds, and we did not have stock market terminals, so we relied on a business relationship with a brokerage firm that would provide us with market quotes back then. And remember, these were the nascent days of computers, so they were not common then as they are today. And so as the market began to fall, the news would filtered into our office that what was going on, and we'd have an open line to this firm in Toronto, and we were throughout the day getting valuations. And I don't remember if it was about noontime or not, but we were saying, what's the market down now? It's down 100. What's it down now? 200. What's it down now? 300. What's it down now? And then the answer came back, we don't know. It's in free fall, and the ticker is behind, and we don't know. And I can tell you, those just relaying that story right now is giving me goosebumps, and how terrified I was, because I was a young guy at the time. I was 25 years old. I just started my career.
One year in.
Yeah, a year prior, I'd put client money in, and I was terrified. I didn't want to see my clients lose money. I didn't know what was going to happen with my career. I thought perhaps it was over. And coincidentally, our firm had a meeting with a portfolio manager in Toronto at Mackenzie Financial, which had been previously scheduled. And so that was essentially a day or two after the market crash. So we went to that meeting, and they were updating us and saying, look, we don't know how this is going to all unfold, but the prices are ridiculously low, and we're buying like crazy with all the cash we have. And then they gave us some perspective about expectations for a rebound, and the timeline that they expected a rebound. They didn't know, obviously, but they said, it could take a year, it could take 3 years, but eventually it's going to rebound. And so the washout occurred, and there was a response by central banks, and eventually markets did begin to rebound again. And it took about 3 years. And unfortunately, we then, as interest rates were attempted to normalize again, they triggered a recession in 1990-91 that was known today as the savings and loans crisis.
Hold on, you're getting ahead of us here, Dad. So before we move into the,
look at it as a preview of what's to come, Alex.
Yes, that's true.
Yeah.
Before we get to the 1990s, which are a great decade because that's when I was born, we're going to just finish out what happened here in 1987. So just to give some statistics to bring some color to what actually happened for those who didn't experience it firsthand. The drawdown on the Dow Jones Industrial Average was 22.61% on that day, October 19th, 1987. The S&P 500 lost 20.47% on that day. Worldwide losses were estimated at $1.71 trillion US. It was the single largest single-day drop in US market history. And one of the potential causes, obviously, there were a number of different things that you touched upon, Dad, but in terms of what caused such a panic level of selling that happened on that one day was this was the infancy. As you mentioned, computers were around. They were not readily available to everybody, but it was the beginning of computerized trading. It was also the beginning of pricing in or computer models pricing in options. And so what was happening was the market started to move, and the options pricing could not keep up with the changing prices that were occurring in the market. And that started to cause panic amongst the large institutional investors because they could not properly price in the risk that was occurring within the market. They could not exercise options to get themselves out of positions or conversely, potentially even jump in to provide support to buy back at certain price levels. And so what ended up happening was a free fall in the market, the aftermath for which was the creation of circuit breakers. So in 1988, the circuit breakers were put in place to prevent drastic market drops from happening again. So as trading is suspended, as soon as the market drops 7%, so what ends up happening is the market shuts off for 15 minutes once the market falls by 7%. After another 6% drop, when the market reaches 13%, there's another 15-minute suspension in trading. If the market drops 20%, trading is halted for the remainder of the day. And so these are safety mechanisms that have been put in place in order to prevent this kind of frenzied hysteria that was happening on that day, when obviously information was not as readily available like it is today, and to prevent people from getting into panic selling, which can further depress market prices unnecessarily. And so one thing I wanted to just cover, Dad, if you don't mind, was I wanted to ask you about your experience with one of your clients, because you told me a story about one of your clients and having to relay that information that was passed along from Mackenzie.
Well, it's interesting because in addition to having that meeting with Mackenzie Financial following the big crash, prior to that, I actually had a pre-scheduled meeting with my largest client, and I went to visit her at her condominium in Don Mills, and I was rather scared. I didn't know how she was going to respond to the events that unfolded. And we sat down together, and she said, "So, what do you think? How do you think things are going to be unfolding in the next little while?" I said, "Well, it's obviously hard to know, but in speaking with the portfolio managers, we believe the market's going to bottom out and eventually start to climb back up, and it's going to take some time." But it will take some time, and it's unlikely going to be months. It's going to be more like years. And I wasn't looking forward to her response, but she was very calm about the whole thing. And she said, "You know what? This is not all the money I have in the world. I don't need it. And we'll just wait. And we'll wait for the recovery." And that was actually, as a young guy in the business at the time, I was very relieved by her response and her very calm demeanor. She was in her mid-70s at the time. Obviously, she had a lot of experience in the world, and was actually a business owner. Prior to retiring, so she was not the kind of person who was going to panic.
Was she the client who I believe her father had lost a lot of money in the Great Depression, or was that a different client?
That's a different client. So yeah, I had a meeting with her too.
That one was the one I was referring to. That's the one I thought you were.
Yeah, well, that meeting occurred the week after that, and she was a referral from the First Lady, and she was not as calm.
Well, she was reticent to get involved in the stock market to begin with. Because of what happened.
Yes. So this other lady, we'll call her
Betty.
We'll call her Betty. So let's say. Betty, when she was referred to me, I met her in the summer of 1987, prior to the market decline. And because I came so highly recommended from the First Lady, she was open to a meeting, and I was explaining to her what we did and how we invested money, and then she told me a long story about how her husband had lost a lot of money in the 29 crash, and it resulted in her having to spend time living with her mother-in-law, which she wasn't happy about. But anyway, she decided to stick her toe in the water, and she put some money in to be invested. And obviously, that was a couple of months before the October decline, and she was very upset about it. Or I assume she was upset about it as I went to her condominium, to her apartment building, to see her and bring her up to speed as to how we viewed things unfolding. And this is again before mobile phones were available. And I got to her apartment. I knocked on the door, and there was no response. And I thought, wow, he's not here. I wonder what's going on. Then I thought, well, I can't phone. I don't have a phone. Thought, okay, maybe I'll go to a payphone, maybe call her. But I thought I'd wait a few minutes. So I waited like 5-10 minutes at her door.
What a world.
Yeah, I waited 5 or 10 minutes at her door, knocked a few more times, no answer. And then, okay, so it cut me some slack here, guys. I was 25 years old, and I was a little bit terrified. Let's just say I was a lot bit terrified.
Yeah.
And I thought, what if she died? She was an older woman. I thought, well, maybe she died. Maybe she's in the apartment. And I'm thinking, oh, that's awful. What am I going to do? Then I thought to myself, well, I don't have to tell her. So I was relieved.
That's a 25-year-old male brain.
That's a 25-year-old male brain. And I said, wow.
But what if it had killed her, Dad? What if the crash had killed her?
Well, that crossed my mind too. That was the next thought that crossed my mind. I was very upset. I can't be happy if the woman died because of this. This is awful. I had all this guilt running through me. So I went downstairs. I walked across the street. I found the payphone. I called. There was no answer. 40 minutes go by. I called again, and she answered. I thought, hey, you're there. What happened? Oh, I was at the hairdresser, and it ran overtime, and I just got home. I thought, oh, well, that's good. In my head, I'm saying, at least she's not dead, right? That's a good thing. But then I thought, oh, geez, now I have to go up and explain myself. So I went upstairs, and I knocked on the door, and she opened the door. I walked in, and we sat down at her dinner table, and we had a conversation. And she told me, so she was very upset, and she was very unhappy, and I was very upset, and I offered to pay her back money, which was that's a big no-no today, by the way. You can't do that. But I was young. I was scared. I didn't know what else to say. And she said, "Where are you going to get the money?" I said, "I don't know. I'll figure out a way." And she paused for a while. She says, "You know what? We'll just we'll listen to what the experts told you at your firm, and we'll wait for it to recover." And I left somewhat relieved, but later on, as markets got better and recovered, our relationship strengthened tremendously. She eventually added more money. She made a lot of money in profits over the course of time. And in the fullness of time, looking back, she said, "I trusted you because you offered to pay me back. And I was looking at you, you're 25 years old, you had nothing. And I knew anyone who was willing to make such an offer can't be a bad person." And so that offer, which I repeat, shouldn't be, that's not permitted in our industry today. And I wasn't aware, I was new at the time, and the regulations weren't what they were today. So probably wouldn't be allowed at that time either. But I was scared, and that's what I said. And that impressed her sufficiently to boost her confidence in me. Mm-hmm. And I didn't pay her back. I didn't have the money to pay her back, and she didn't ask me to pay her back. but it all worked out in the end over the course of time. We had a great relationship. She was one of the nicest people I ever worked with, her and along with the lady who referred her to me. And to this day, I'm dealing with her children. So
Wow.
it turned out to be a very good relationship. And the markets, and the moral of the story here is the markets eventually did recover and did go on to higher levels.
It did, but you can. I want to jump in here because one of the things that strikes me in that story, John, in addition to the point that you just made, is it underlines something really important here in the sense of it's really important to trust your financial advisor. Yeah. It's important that, when you're looking at a financial advisor, choosing one, that you choose somebody that you can look at and go, I trust this person. They're not until they're going to make me an offer to give me my money back. But there's a sense of trust. There's a sense of that in the relationship.
My first, and that's a great point, Bill. And my first client who referred the second client, and let's call her Lucy. Lucy, when I met her, and she gave me a large check to invest on her behalf. Upon giving me the check, she said to me, I'm going to Florida for 6 months, take good care of this. And I was flabbergasted that anyone would give me such a large sum of money and then trust me enough to look after it while they were leaving the country. And what I did following that deposit, and this was a year earlier in 1986, is that because I didn't have any other clients, I would, on a typewriter, type her a letter every week and give her an updated market value of her portfolio and let her know what was going on in the financial news. And she was so impressed by my level of communication for the 6 months she was away that it just boosted her confidence immensely. And many years later, she said to me that she has a good sense about people. She can sense when people are good and trustworthy and honest. And unfortunately, later in life, she passed away at the age of 96. She was my client for 22 years. But in the final 5 years of her life, she developed dementia. And when I used to go visit her in the long-term care facility, I would introduce myself. She says, "Do I know you?" I said, "Yeah, you know me. I've been looking after your investments for 20 odd years." And she says, "You know what? I don't remember you, but I know you're a good person." And that was really heartwarming.
Yeah, it's heartwarming and high praise, John. High praise.
Yeah. So, and she too had children, and they too, to this day, are still working with me. So, I've prided myself on always being open and honest with people and having excellent communication. And I think with excellent communication comes trust.
Yeah, I think that's the big takeaway here from the 1987 event was, in order to get through these events, because obviously they do happen from time to time, and we're likely to see some events of a similar nature occur in the future, hopefully not to the same magnitude. Just to remind people, or to give context, further context to what I gave earlier, people were afraid in 1987 that this was going to be a second coming of the Great Depression when it happened. And so it was a deeply troubling time for investors and the average citizen. And what became a key takeaway from that was how, in order to deal with these types of events, communication is key. My dad, we'll get to the early 2000s in the future, but one of the things that my dad has talked about at length in the past is the day after 9/11 occurred, each and every one of his clients had a letter from he and his business partner on their doorstep the next day. And how it's important that whenever these types of events happen, we know they're going to happen. They're beyond the control of any one individual. But what's important to manage these events is to communicate. And effective communication can help ease the burden and ease the pain. And so with that, I'm gonna slowly transition us over here. So we got out of the 87 market crash. We got out of the events that transpired there, and I wanted to get your perspective, Dad, on what came next, which was the savings and loan crisis of 1989 and into the early 1990s.
So, as I noted earlier, following the 87 crash, there was a response by the central bank to ease the money supply a little bit, but then they did that for a short time, and they went back to raising interest rates to try and avoid having a major inflation, and that pricked the real estate bubble that had been brewing throughout the 1980s. And we ended up having in the United States a collapse of hundreds of savings and loans, which are small banks in the US that were highly leveraged to the real estate market. And that created a new market decline in the early 1990s. And then to compound that, in 1991, we had the first Gulf War, which erupted in January of 1991, just about a month before you were born. And that was a very stressful time. And I was agonizing as a new father what kind of world I was bringing my child into. So that took a couple of years to play out, and the market declined by a significant amount at the time. So once again, the emphasis here was on communication with the clients, explaining what was going on, helping them understand. What is interesting, though, is today we have so much information available. We're so in tune with what's going on in the capital markets. We get reports on a daily basis. But there's an old expression that says ignorance is bliss. Back in 1991, I had a lady who was retired, a widow, and she had money that had matured in a GIC, and she wanted to invest the money for the benefit of her children. So she didn't need the money, and she says, invest it in a way that's going to grow as much as possible. And this is after the market had already declined by a material amount. And so I did. I invested it in a good mutual fund at the time, and she never paid attention. She couldn't care less. She says, this is a gift to my kids. I'm not going to think about it. And by the time she passed away, which was about 10 years later, the account had tripled. So she performed extremely well. But it's the key here is she wasn't trying to second guess what was going on in the world. She wasn't trying to be an economist. She wasn't trying to be a stock market guru. She wasn't worried about political events unfolding. She just said, I want to invest this money for growth. You know what you're doing. Invest it for growth. And then she forgot about it. And as I said, ignorance is bliss. She didn't pay.
And I think what ends up happening is the people who are daily market value checkers, if you will. I'm trying to find a better term for it, but we'll just go with checkers. I used to deal with them a lot when I used to work at CI Investments. I started in as a financial services representative over there. I used to have a gentleman who called in every single day, wanted the market value of his account. And I remember thinking, what are you doing with this information? Because what ends up happening is if you check every single day, you end up riding a roller coaster of emotion where you're constantly tied up in the ups and downs of the market. And obviously the markets are never flat or steady. You know, everybody would love a 45-degree angle straight up in perpetuity, but that's not the way things work. And there's a lot of little bumps and dips along the way. And what ends up happening is a lot of times people make panic decisions that end up hurting the long-term value of their portfolio because they get tied up in short-term fluctuations, and that can significantly erode value when it comes to achieving their long-term goals. One of the things that we tell our clients, and my dad mentions it every single week in his newsletter, is volatility is not risk. The real risk is the permanent loss of capital, which occurs when you sell and realize the losses in your account. And so we always try and provide perspective and guide people so that they don't get tied up in the minutia of the daily market meanderings. We need to maintain long-term perspective, and that's where we come in. Is our job is to help clients maintain long-term perspective, understand what's going on, and then make the appropriate decisions without the burden of behavioral biases and emotional ties to the money that's that is being invested. So anyway, John, I'm gonna.
Sorry, just to add context, I spoke about the market falling in a material fashion. The decline was about 25% during that period from peak to trough in the S&P 500 index.
And so, tell us a little bit specifically about the savings and loan. Like what exactly happened?
Well, the interest rates were going up, and there was rampant speculation in real estate. I remember in approaching prospective clients in the late 1980s, speaking to them about investing in stocks via mutual funds. People were let me backtrack a bit. The objective is always financial planning, accumulating your assets toward building capital for your retirement. So the vehicle were the mutual funds to grow your money. And people at the time were saying, well, why would I want to do that? I own this property and I have this investment property and I'm making money and making big money and I'm buying additional properties. And, everyone owned the property. And, it got to the point where unsophisticated people were this is, I don't want anyone to get offended, but elderly people who had no fundamental understanding of economics or money or investing were saying, well, I want to buy a condo to invest in. And so there was this euphoria about investing in condos before they were constructed, pre-construction condos. And so there was this mania going on with real estate. So it was happening throughout North America. And it got to the point where the real estate valuations were excessive, interest rates were starting to climb because of inflationary pressures. And it got to the point where people, through the higher interest rates, could not afford to pay the prices for the mortgages or the lending. And so you had, when buyers run out and sellers exceed buyers, you get a decline. And that's what happened. And unfortunately, in the US, the banking system is very different than the banking system here in Canada. And many of these organizations were very small, but collectively they added up to a big amount. Interestingly enough, in that period, Canada had its only life insurance company bankruptcy. It was Confederation Life, I believe. And it was at that time, all the trust companies here in Canada. And back in the 1980s and before the 1980s, the financial industry was separated into what were known as the four pillars. You had banking, you have trust companies, you had life insurance companies, and you had investment dealers. And they were all separately owned and had nothing to do with one another. After the 87 market crash, because of a lack of liquidity in the financial system, the independent investment dealers could not afford to remain independent. At least most of them could not. And so they were all acquired by the big five banks in Canada. And today we know RBC Dominion Securities, but it used to be called just Dominion Securities. And similar situation with the rest of the banks. Once the savings and loan crisis happened, all these companies in the States, there were savings and loans, but here in Canada, trust companies were specializing in lending to commercial property buyers and also to individual property buyers. And they overextended themselves on real estate lending. And so when the crash happened in real estate, they were having financial difficulty. So the banks, once again here in Canada, stepped in and bought up all the trust companies. And unfortunately, one of the life insurance companies, Confederation Life, actually did go bankrupt. So it was a very tumultuous time in the early 1990s. Real estate investment mutual funds actually existed at the time, which was very unusual if you think about it, because real estate is an illiquid asset. It doesn't have a mark-to-market mechanism on a daily basis. It's based on appraisals. And yet there's these mutual funds that existed that allowed people to invest in commercial real estate and get priced daily, yet the underlying asset is not priced daily. And so this was an incongruency that could not persist in that environment. So what happened was the real estate mutual funds were all locked. The mutual fund sponsor essentially froze those mutual funds. Money could not come out. and until they allow time for things to recover. And one of the more well-known ones at the time actually converted to what is called a REIT now, Real Estate Investment Trust, which trades on the market and has daily valuation. But in the course of converting, and it had to mark to market, it had to recognize the true value of the underlying real estate, and it took a 50% haircut.
Wow.
Which was huge. And subsequently did quite well. You know, anyone who bought into it back then did quite well over the course of time. It was a well-managed fund. There was nothing wrong with the way it was being managed. It's just a function of what was going on in the real estate market at the time. So again, a very tumultuous time, a lot of communication with clients, a lot of hand-holding. And eventually things recovered, and as we know, the 1990s ended up being one of the best decades for the financial markets in history.
And Dad, one thing that I want to touch on, just going, because you and I actually talked about this recently, was the savings and loan crisis draws some similarities to what has been occurring recently. We've had a similar real estate craze, as we talked about in our episode with Corrado Russo, especially here in Canada and the GTA, but also elsewhere. There have been significant increases in real estate valuations, in part due to the interest rate environment that we're currently living in.
Well, so, I would say that less so today and more so in the period leading up to the Great Recession, 07, 08. When the 07, 08 crisis was unfolding, I was at the time thinking about the savings and loan crisis and saying this is very similar to that. And that was the parallel I was drawing at the time. Today, the circumstances behind the real estate exponential increase in North America, more so here in Canada, has a lot to do with
demographic changes.
Demographic changes and the influx of immigration that is essentially unhindered. So I think the situation today is somewhat different, and also the banking industry through government. I shouldn't say government intervention because they did not intervene, but essentially it was an agreement made between the government and the banks that they would take on mortgages only if people would qualify at what they considered a more normal rate. So when interest rates were down at 1% and 2%, you weren't being qualified as a purchaser based on those interest rates. You were being qualified on the basis of 5% and 6%. So what's going on today with interest rates going up and rates going higher, there's going to be less of an impact on Canadians. That's not to say there won't be an impact. There still will be an impact, but it's not going to be on the magnitude of the savings and loan crisis in the U.S. like the early 90s or the 07, 08 Great Recession.
Okay. Yeah, and that's exactly where I was going to chime in with that as well. I think the other thing to keep in mind here, because we did get a question about this yesterday during our prospect presentation that we held, was whether or not we expect a crash in the Canadian real estate market, an imminent crash, I guess is a better way of phrasing that. And the way that I answered that last night was based on the current information that's available, it seems unlikely that the Canadian Mortgage and Housing Corporation, CMHC in Canada, recently released research that stated in order to bring housing prices back to early 2000s pricing levels, we would need to build an additional 3.5 million homes across Canada. So that would suggest that there's ample demand still for housing and real estate within Canada to not allow prices to go into a free fall like they did in the late 80s and early 90s. Now, before we wrap up here, Dad, I just wanted to ask you really quickly, do you have anything you wanted to add on the Gulf War, and that can be condensed into a minute or two, or do you want to save anything on that for our next episode?
I will say briefly that about 2 days before the Gulf War, I was a guest on the biggest Toronto radio station on a radio program that's focused on money, and it was a call-in show. So we were talking about what's going on at the time, and there was the amount of panic was incredible. people were calling and saying, are we going to see, because the war was imminent. It was at that point led by the U.S. There were forces amassed in Saudi Arabia in the staging environment about to enter Kuwait, and people were calling and saying, this is horrible. It's the beginning of the Third World War. Should we be selling everything and buying gold? These were the nature of the questions I was getting at the time. Stocks are going to continue to be terrible, and even as a young guy back then, I did have enough knowledge of economic history and market history that I responded by saying, look, this is not the beginning of the Third World War. This is not, Nazi Germany, 1939. This is a regional conflict that is unlikely to last any material length of time. And the stock market is at depressed values at the present time. And it's actually a great buying opportunity. And I mentioned at the time, I don't remember the number exactly, but there was a vast amount of money sitting on the sidelines in cash. And I said, once this crisis dissipates and this money starts moving back into the market, we're going to have a huge boom in the stock market. And that's precisely what happened in the ensuing time period. Interest rates started to come down. The war was wrapped up in a rather short time frame, and things recovered. And it was the 1990s ended up unfolding into being one of the best decades in history for growth of capital in the financial markets.
Absolutely. So with that, I think we'll. I was hoping to get to the Asian financial crisis, which was brought forth by the Thai baht devaluation, but we're going to save that. So it's 1997. So that's a little preview of what we're going to cover in our next market crises episode. I think based on how far we got today and how much information we had, this is probably going to end up being a three-part series. So we'll tag this as part 1 of 3, to be followed by the Asian financial crisis, the dot-com bubble, and then eventually get into the Great Recession in the late 2000s. So with that, I'll turn it back over to you, Bill.
Yeah, fascinating episode. Brought back a lot of memories for me as well, because
some of them unpleasant.
I remember the S&L crisis very vividly as well, and it's devastating to realize the impact that bad real estate markets can have on badly managed banks when they're leveraged in that kind of way.
Well, and Bill, you being in the United States, you probably had a front window view on what unfolded, and if there's anything I said that was not accurate,
no, you were spot on, and I was looking out the window of the plane at the whole mess, thinking, oh, good grief, man! It's amazing. It is an instructive period for people to look back on, because it's good to remember that markets don't always go up. No market always continually goes up. Markets go up, they go down. Markets can be extremely volatile. So this kind of perspective, I think, is really useful and helpful for people when they're looking at the markets and they're having their conversation with their financial advisors about what can happen in markets. There are no guarantees. There are trends. There are things that you can lean on, and certainly trust in your financial advisor is one of those key points. And speaking of that, anybody who's been listening who aren't currently clients of yours, how do they reach out to y'all and get in touch with you to maybe have a further conversation?
Absolutely. They can reach out to us at info@medwealth.ca. That's info@med-wealth.ca. They can go to our website, which is www.medwealth.ca. We're also available on LinkedIn and Twitter. And they can reach us by phone. All that information is on the website. So feel free to journey over there and get everything that you need.
That's excellent. Great, guys. Thank you very much for this episode. Thank you, listeners, for listening. If you like what you heard and you're not a subscriber, please hit the subscribe button. That way you don't have to remember when John and Alex have the next podcast, because you'll get it. They'll be delivered to you. If you like this podcast, we humbly ask that you rate it and share it with other people so that you spread the word about the good work that they're doing and let others know about what's happening. Please, if this episode reminds you of nothing else, don't wait. Live your best life today.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.